Hi, it's Harry Dent with another update. Given the surprising little crash in August, first I want to let everybody know that we have a new book coming out. I've co-authored this with Rodney, president of HS Dent. It's called The Great Crash Ahead, and it's going to come out about September 20th. So a lot of people may want to get on the pre-order list at Amazon to get that as soon as possible. You can probably get a little earlier, and I'll also mention that at the end here. And just to recall, our last update was in February when we had been in a position of kind of looking at the markets continuing to go up longer than we originally thought in the Great Depression Ahead book because of, the QE2 to follow the QE1. I mean, the government has just had endless stimulus here. And in more recent months, we've been looking for a scenario much like the tops and the bubbles, and the top that came in 99, early 2000, the first tech bubble, and then the next bubble in late 2007. And both of these tops, the rally got to a point kind of like April of this year where it started to stall more, and you just make slight new highs, and there's a point in both of those topping processes where you get a correction like this, where the market goes down more steeply, looks like it's topped, and then turns around and makes one final new high, just a slight new high before the major top. That's what we were expecting. And then we were watching this crash unfold and say, oh, this is perfect. But then the crash went a little lower than we expected. When it broke below 1,130 on the S&P 500, we were saying, wow, that's a little too far just to be a correction on the way up. So we do now think that the market did more likely peak in late April of this year, 2011, when the S&P 500 hit 1370. We think now this is probably the first wave down of a broader crash that we've been expecting, obviously, for many years. To play out between into 2012 and into 2013 likely. Very similar to the 1973 to 74 crash that followed the peak in the bull market back then in late 68 by 4 years. That's when baby boomers get out of their plateau stage from 46 to 50 and actually start declining in income and spending. So it gets harder and harder for the Fed to stimulate. And as we have been saying from the beginning, the Fed stimulus was going to fail at some point. It couldn't fight 92 million baby boomers saving instead of spending, massive shift, and what we now count up to $122 trillion in private debt, government debt, and unfunded entitlements for health care and Social Security long term. So we think this is starting to happen. We think in this first wave down, we could see one more wave down of this into maybe late September, mid-October, something like that. So there is very strong support at the lows back in early July of last year when the Dow was bottoming between 9,600 and 10,000. For the S&P 500, that was 1,010 and 1,040. So there's a good chance we'll get a bounce maybe into late August, early September, and then we come back down and make a new low, and then we see a stronger rally year end. Now, one of the reasons we suspect that we may still see a pretty good rally after this is that one of our leading indicators in our newsletter, the Daily Growth Index, which is real-time spending on the internet, so this is not something most economists see, has saying since late May that consumers have been starting to play catch-up in spending from the Japan shock and the oil shock that happened in the first and second quarter of this year when GDP came in surprisingly low when they revised it. That's another reason for the crash. We had Italy imploding into the debt crisis, which was the worst news, and we had U.S. GDP, first and second quarter, much weaker than thought. So that's what's happened here. So if we get any more bad news on Europe, I think we could see one more correction down. We're going to be telling more conservative investors, you may want to sell on this bounce here because we may bounce, go down again, bounce broader, but not come back much higher than we get here, maybe 1220 or so on the S&P 500. So conservative investors may want to just get out. This market's too crazy. It's too hard to read. And then we're going to tell maybe more aggressive investors, yeah, you may want to lighten up or get out here. If we see one more plunge down to that kind of 9,600, 9,800, maybe 10,000 level on the Dow, then buy for this final rally. I mean, it could be substantial, 20, 25% from there. And we get back late year in, and then you get out altogether. The other things we're telling people in this time, do not be piling into Treasury bonds. Everybody piled into Treasury bonds, particularly with the bad news in Europe. Drove the yields down to 2% when we have 2% inflation right now, roughly. That's not a good deal. At some point, these bond yields are likely to bounce back with a recovering economy short term. And at some point down the road, when we fail again, which I think would be early 2012 or so, then those yields could start going up again because people are saying, like in Greece and Italy, oh my gosh, even the credit of the U.S. government is in question. And of course, we did get downgraded by S&P, and I think there's more downgrades to come. When the economy weakens and when the markets see a bigger deficit, $2.5 trillion instead of 1.3 to 1.5. So don't be piling into Treasury bonds. There's going to be a great potential to do that maybe several months from now, as we've been looking for when yields spike. Do not be piling into gold and silver. We gave a sell signal, a half sell signal in gold and silver when silver hit 49 to 50 bucks in late April, right at the top of the stock market. We're looking to give a second one. Perhaps if we see another downturn in stocks and gold goes up one more time. Gold has made new highs. Silver hasn't even come close. So we probably got the top in silver. We're looking for the next sell signal if gold goes maybe a little higher. It's possible it peaked here near 1,800, but do not be buying gold. When gold and silver go down, they're going to probably see the biggest crash. So again, I want you to look for our book coming out on September 20th. We'll show a picture of the cover here at the end, and you can go to Amazon.com and pre-order this book if you want to get it earlier than other people. Get it as fast as possible because they're going to get inventory before that pub date on September 20th. And then we look for a very volatile market from here on out and likely have seen a top. And basically, people should be looking to sell on bounces, stocks, and commodities. Thanks for listening.